Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott. I'm pleased today to welcome Daniel Lacalle, CEO of Alpha Strategy and author of multiple books on the economy and the world of energy. Such titles as Escape from the Central Bank Trap, The Energy World is Flat, and Life in the Financial Markets. So, Daniel, thank you for joining me today on Sprott Radio.
An absolute pleasure. Thank you so much for inviting me.
Well, Daniel, and we'll go with Dan. How about that? I'm Ed. You're Dan. We'll go with
Absolutely.
that.
That's great. Yeah. Yeah.
In prepping for this podcast today, you've got an extensive background both in the global economic standpoint, talking about the economy, but also in the energy markets. And I want to unpack a lot of that today. But before we do, could you tell us a bit about your background and your career and the work you're doing over at Alpha Strategy?
I'm an economist by degree. I started in the energy industry in oil and gas. I was in charge from international finance to Africa and the Middle East in an oil company for quite some time. Afterward, I was always interested in financial markets. So I had the great opportunity of being hired by an investment bank, joined that investment bank, and very quickly, actually, received an offer to join Citadel in the buy side as a hedge fund manager. I worked at Citadel, then at Ecofin, then at PIMCO, and afterwards at Tressis as a fund manager. And now I'm a chief economist. I'm also a PhD economist. I'm chief economist, and in Alpha Strategy, what I give is advice to companies in everything that goes from strategy to macroeconomics to energy. So I didn't want to go into too much length. The resume is not much more than that.
Well, it's pretty extensive. I think you're doing yourself a disservice. And I have to ask you, between doing your analytical work and your research, how in the world do you find time to write? I think my last count was 7 or 8 books
Yeah.
on the economy, on energy. Where are you finding the time to do all this?
I'm always writing. What I do is that every time that I'm thinking of something or that I'm researching something, etc., I'm always writing my thoughts. And I keep them in different folders. And it allows me to think of themes and ideas and revisit what I have been thinking in previous months. So all of that informs my articles and my books. So it's almost like a circular strategy in which if I'm going to give a keynote speech, I'm thinking about a number of things that are also going to be used for my books or for my articles and
Mhm.
my videos. So ultimately, doing all I can to basically write as much as I can all the time. And I find that it's something that I enjoy, and at the same time, something that helps me a lot in producing more content.
Well, I think you were ahead of the curve in talking about central banks. I think your book back in 2017, Escape from the Central Bank Trap, is really timely today.
Mm.
At Sprott, we focus on precious metals and real assets, and central banks are really driving kind of the gold narrative right now. So maybe talk a little bit about that. When you
Mm.
talk about the escape from the central bank trap, let's unpack that concept a little bit.
Well, the idea was basically to try to tell people that the world that we were living in and that we continue to live in terms of monetary policy, is completely abnormal. And it's not something that people should think has no risk. And what I wanted to explain to the average reader is what the hell is this? Monetary policy, quantitative easing, what is everything that is going on and why you should protect yourself. And there's an entire chapter about gold, and it's called Escape from the Central Bank Trap, because what I was saying in the book is what we are seeing right now is that we were told a narrative that made absolutely no sense, which was that central banks can always increase the money supply, can always continue to inject liquidity with no discernible consequences. And what I mentioned in the book was there is going to be an inflation burst, there is going to be a reduction in the confidence of sovereign issuers, and citizens need to be aware of that and need to protect their wealth and protect their savings by escaping from it through hard assets, cryptocurrencies, gold, and other financial assets.
I think your point's well taken. Global currencies. It seemed like for a while it was a U.S. dollar versus everyone else.
Hmm.
That seems to be changing a bit, and gold and cryptocurrencies overall are starting to become part of that narrative. Can you talk a little bit about that? How is the world of currencies evolving right now?
Oh, I think we're living the complete meltdown of the post Bretton Woods world, in which central banks all over the world started to get rid of gold and started to use as the reserve asset developed economies' debt, US
Hmm.
debt, also euro area debt. The euro area was initiated, and this led to the perception that developed economies with a world reserve currency could increase their debt and massively increase money supply without any real consequences. Because what is debt for a developed economy is an asset for an emerging economy, and its central bank, in order to maintain a certain stability of the local currency, needs to hold a tremendous number of treasuries or European debt or developed economy debt or UK gilts. All of that is breaking. All of that is disappearing. When governments implemented the atrocious mistake, not a mistake because it was done on purpose, but the experiment of 2020, which was to increase massively money supply and government spending in the middle of the lockdown, and at the same time bring rates to exceedingly low levels, negative real rates, what that created was the inflationary burst that we are still living today. And that also generated a very substantial impact on developed economies' central banks. Central banks started to incur in very significant losses. The Federal Reserve, the European Central Bank, but also those central banks that held treasuries or gilts or any of the developed economies bonds in their asset base. So, first year of that happening, many of them thought it was temporary. But it's the third consecutive year of losses in the bond portfolio. And that is showing that fiat currencies are surpassing what I call the three limits: the inflationary limit, which we have just discussed, the fiscal limit, which means that it doesn't matter if you cut rates or if the central bank purchases assets, the interest expense and continues to rise in the budget and makes it even more challenging, and the economic limit, which means that higher debt, higher government debt does not generate any type of multiplier effect in the economy. Those three limits have been exceeded. A lot of central banks all over the world have decided, I don't want more treasuries. I don't want more European debt. I don't want more gilts. I want gold, and I want gold back in the balance sheet, because that is actually what can give me and my currency, the domestic currency, stability and a certain level of true reserve value.
The debt thing I think is fascinating because it wasn't that long ago that very senior people in political seats were saying debt doesn't matter. We can print more of it. We have people to buy it. We can keep moving this around. It's
Hmm.
starting to seem like it matters now. What was the tipping point of that? At what point was like, oh, wait a minute, we went too far?
I think that it's the inflationary limit, because the economic limit, governments don't care. Governments don't worry when too much debt brings stagnation. Look at
Hmm.
France. No, they don't. They're not worried about it. They actually even demand more debt. The fiscal limit is not a problem either for governments, because they will always say, "Hey, I'm going to raise taxes."
Right.
Um, so nobody cares. Nobody cares in the political environment. Now, the inflationary limit, my friend, the inflationary limit has completely destroyed the narrative of sovereign debt is always going to be a reserve asset that will be demanded by the private sector, and therefore governments can increase money supply and debt as much as they want. That is the evidence of the insolvency of an issuer. Inflation is the evidence of the insolvency of an issuer, the same way that rising bond yields are the evidence of the worsening solvency ratios of a private debt issuer. No, so I think that that is what has changed, and also the alarm bell of a lot of governments that were used to the idea that it didn't matter how much they issued
Mhm.
every year, they would have two, 2.5 times, 3 times bid to cover. And that is gradually changing. And it started very fast. It started with the PBOC, the Chinese central bank, reducing sovereign debt holdings. It continued with countries like Poland, countries like Oman, Saudi Arabia. A lot of people actually try to give a spin and say, oh, it's because of the Ukraine war. The countries that are close to Russia don't want to hold developed economies' sovereign debt because they are supporting Ukraine. Well, makes no sense because one of the largest buyers of gold is Poland. Another one is Turkey, Oman, which is completely unaligned. The narrative is starting to crumble. And a lot of governments are getting very worried, very worried. That's why the European Union, the euro area, wants to accelerate the experiment of the digital euro.
Well, I think it's interesting talking about digital. In this digital world, with AI and everything, we're going back to real. We're going back to hard assets. We're going back to things we can touch and hold. I think it's fascinating the loop that we're in. Well, let's stay on this for a little bit longer because geopolitics have historically kind of evolved and have impacted economies over the world and have moved markets. But if you step far enough back, they don't really have true impact.
Hmm.
What's your thought on that? What is your view on kind of geopolitics in the state we're in right now, and how is that driving the markets?
Geopolitics matter, but they don't matter the way that many market participants assume, which is an immediate and abrupt impact on asset valuations.
Hmm.
It impacts on erosion of investment, erosion of capex among international multinationals and exporting nations. It also manifests in this monetary realignment that we are living. We see more countries that are siding along China, other countries that are siding along the United States, and we are seeing actually a world in which instead of de dollarization, we are seeing re-dollarization of many economies, and others are yuanizing, if that word is
Hmm.
even that even exists, their economies, which is basically taking more debt in yuan. So geopolitics is very, very important. But it's very dangerous to think, oh, there's a war, therefore asset prices are going to decline. That is not necessarily so, because the driving force of markets is liquidity. And usually, when there is an enormous geopolitical challenge or a conflict like the Ukraine war or the attacks on Israel, all of those immediately generate a very aggressive response from central banks,
Right.
almost in a concerted way. So it's no surprise that you don't see the kind of impact that you would rightly assume looking at the fundamentals, i.e., that you would see equities go down, commodities go up, that kind of thing is actually because the market is actually more focused and dictated by money supply growth than the geopolitical risks. But geopolitical risks matter a lot in terms of growth, investment, manufacturing sector, and the monetary developments that we were mentioning.
So we'll try to sum up the market part of this with what's your take on the financial markets today then? Because I watched a couple of your
Yeah.
most recent interviews and you actually seem pretty positive on it. So what with all these things happening, what's your take right now? Where do you think we are?
Why am I surprisingly positive on
Yes.
markets? Okay, because everybody says, "Oh my God, this is a disaster. This is a
Right.
disaster," and a lot of the things that everybody is saying, by the way, are very valid arguments in terms of trade war impact, all these things, absolutely valid. But we need to pay attention to money supply, and money
Hmm.
supply is soaring, and money supply is soaring. So equities and markets are always reacting with a lag. It depends. It's usually between 2 to 3 months, but not more, to abrupt changes in money supply growth. We had a very significant decline in money supply growth in the period between September 2024 and February 2025. That manifested itself in markets getting quite a bit of volatility and a substantial decline in some cases. But also, at the same time, What we have seen is the opposite happening very, very recently. And that is super important because that leads the market to defend itself against inflation. And by inflation, I mean the destruction of the purchasing power of the currency. Therefore, even if the annualized rate of inflation CPI may be declining, money supply growth and inflationary pressures continue, and those are reflected in equities in particular. So I absolutely agree with all of those that present a very, very valid set of arguments against the risk assets. But I always have to remind people it's an escape from the central bank trap. The
Right.
market is all about money supply growth. Money supply growth up, markets up, money supply growth down, markets volatility.
And so are tariffs just kind of smoke and mirrors or noise right now then? Do they
Yeah,
really, I mean, of course they matter, but are they really going to drive the market? It seems like we've kind of already moved past it
yeah,
as, the US and China are now talking. Seems like
yeah.
it was kind of a hiccup in the world. What's your take on the tariff environment right now?
Well, tariffs were always going to be a negotiation tactic, a
Hmm.
sort of fist on the table type of negotiation, no? In which the Trump administration was going to go to the world and say, we're going to put tariffs on everybody and then start negotiating. That is what it's doing right now. At the beginning of what I call the tariff tantrum, a lot of market participants, and certainly I would say the vast majority of investment bank analysts, went immediately to make a worst case scenario analysis
Right.
of the tariff situation. And obviously the results were atrocious. Think about it. You make an analysis of global trade and add 20% tariff on everything, the impact is brutal. No? The two most dangerous words in economics are ceteris paribus. And all of the economists in investment banks use ceteris paribus. So they basically get their models have all of the variables unchanged, and then they suddenly increase a dramatic negative impact like tariffs. Obviously, the result is brutal, but it's so unrealistic.
Right.
I think that what the markets have finally learned is that it was always a negotiation tactic, maybe a scary negotiation tactic, maybe a challenging one. But I think that what markets are doing right now is that at the beginning they immediately started to discount the worst case scenario,
Right.
and now they're starting to say, "Oh, wait a second. Instead of being 100% or 120% tariffs on China, it's going to be 30. Oh, that's fine. 30% is like basically, and people are starting to make their own assumptions because, for example, I was saying to European companies, you're really telling me that European companies cannot sustain a 20% tariff when European companies have sustained an increase of 50% in taxes? Mhm.
Yeah.
Of course.
Right.
So that's basically the market is basically just adjusting to a different reality. At the beginning, it was a reality that Trump only wanted tariffs to hurt the economy and to bring a tremendous amount of revenues to the United States. And now people are starting to understand he's negotiated with the UK, negotiated with China. If he negotiates with China, everybody else is coming afterward.
Right. Well, I know you like money supply, and I think you're spot on with that. Any other indicators out there that you like right now, or you're looking at to give you, sort of a pause or appreciation for kind of the health or weakness of the economy? What else are you following right now?
Credit card usage, capital expenditure announcements, very important. An economy doesn't go down the drain the way that people think it does, no? And companies certainly don't decide to increase inventory and increase investment if they truly see that new orders are declining dramatically. When you look at the PMIs, I like to look, for example, at new orders and the strength of those new orders, even if there is a slowdown. When it's about consumers, I like to look at credit card usage and I like to look at the changes. I always look at rate of change instead of absolute figures, no? Because
Mm.
absolute figures tend to give you a very aggressive view, no? Everything that I'm looking at, from consumer behavior to company behavior to investment trends to manufacturing and services sector trends to financial sector trends, very important as well, credit growth, etc. All of those tell me that the economy is preparing itself for a slowdown, but not for a recession. You know when you could see that the economy was preparing itself for a recession? In 2020. In 2020, companies and families immediately reacted the opposite way that government said that they should do. They completely ignored the science saying, don't worry, this is going to be good, and continue with business as usual because we will get out of the COVID situation quickly. No way. People said, bam, save. Save like
Right.
there's no tomorrow. And that's why we didn't have a recession afterward. No? Right now, the economy is certainly showing a slowdown, but not the kind of crisis or the kind of slump that markets seemed to discount, at least at the beginning of April.
Well, and it seems like that money supply then and all the cash on the sidelines as well is going to continue to sort of not prop up, but continue to support the market.
Absolutely. That's another very important factor. So much money went to money type investments, no?
Hmm.
It's so important to see that there's a tremendous amount of money that is in the sidelines waiting for an opportunity to invest. Another factor that for me was very important was to see an acceleration in share buybacks. Because usually if companies see a crisis, they start to hoard cash.
Right.
They don't accelerate buybacks, no? And that's another important factor.
So it looks like we're doing okay.
We're not doing okay. Let's go back to escape from the central bank trap.
Yes.
We are getting slowly roasted.
Hmm.
If that makes any sense. The economy is in a secular stagnation. The global economy is suffering from the enormous debt accumulation problem. All those things are true, but precisely because of that as well, economic cycles are shorter, abrupt, and they subsequently lead to more money supply growth and
Hmm.
more inflationary pressures on assets. So, the point that I'm trying to make always is that yes, there may be a very significant correction. Yes, as well, that correction will be an opportunity to look at quality at a reasonable price for long term investments. Because what you really need to pay attention to is not geopolitics, is not tariffs, is not China, is not Trump, is not all the headlines that we read, but
Hmm.
the fact that the disaster that has been created monetarily in the last 10, 15 years is only going to be addressed in the only way in which governments and currency issuers have and tried to solve it in the past, which is currency debasement.
Hence, gold, cryptos, other types of assets are
That's
stepping
it.
up and filling that void.
Yeah.
Fascinating. Let's shift over to energy because it
Yeah.
seems like energy and the markets and the economy are being woven together more than I've ever seen. And more recently, you talked a lot about this. The most recent blackout we had back in late April in Spain and Portugal, and
Yeah.
what that sort of has started from a conversation standpoint. Can you first talk about what actually happened, and
Hmm.
then from there, are we going to see more of this in the future? What does this mean from an economic standpoint? What does this mean from an energy standpoint? So start with what happened in Spain a couple weeks ago.
What happened in Spain is the following. We have been used to building an energy mix that is more volatile and intermittent and getting rid of stable baseload energies. What that has done is to make the grid more unstable and more unreliable. What people don't understand is that you just don't substitute a 500 megawatt nuclear plant for 500 megawatts of solar power. It seems the same for people, but installed capacity and inertia are not the same. And solar and wind are great technologies in a mix that has baseload energy, that has synchronized capacity, and that has the amount of baseload energy that allows for the grid to remain stable. It's a basic principle to understand inertia. What has happened in Spain is very simple. The government wanted at all costs, and obviously the cost was enormous, wanted at all costs to present itself as the first developed economy that achieved net zero. They ignored the warnings of the grid operators. They ignored the warnings of the utility companies. They ignored the warnings of the previous blackouts. A week before the
Mm,
blackout in Spain, there was a massive blackout in one of the main train stations in Madrid, and they ignored them completely. And obviously, this happened. If the blackout had been for any of the reasons that the Spanish government and the so called Greens, which are not green, say that were the causes, the blackout wouldn't have lasted 10 and a half hours without power and without communication. This is the first blackout in the history of the OECD in which there's been no power and no communication for 10 and a half hours. In Madrid, other areas, 20 hours. So why is this important for the rest of the world? Because the rest of the world is doing exactly the same thing, which is eliminating baseload, inertia driven energy that provides stability and exchanging it and offsetting it with technologies that have great advantages in many aspects, but don't provide inertia, are unstable, are intermittent and volatile, which are solar in particular
hmm
and wind. So it's a warning. It's a warning for everybody because this whole nonsense of net zero is making things that were supposed to be a thing of the past, like blackouts, come back.
Well, and that's the question, right? As controversial as this may be, do we need net zero? We talk about energy transition, transitioning from one kind of energy to another. And I've heard more recently, and I really like this, is it's really more an energy addition is what we
Yeah.
need. We need additional ways to create energy. So do we need net zero or do we need ways to move towards a net zero, but yet continue to have security and safety of energy? What's your thought on that?
There are three elements. There are the pillars of energy policy: affordability, competitiveness, and security of supply. Without those three, you don't have an energy policy, you have a time bomb. So, do we need net zero? I always answer it this way. When I talk with environmentalists or so-called environmentalists, so-called greens that think that solar panels don't need any mining, etc., I always say to them, "And why not gross zero?" And they say, "Why? What? No? Why not gross? No? You think of net zero as the solution to the world? Why not gross zero?" And you see what happens is that have been accustomed to repeating a mantra and they just don't
Mm,
understand what that means. What does net zero mean? Net zero means impoverishment. We don't need net zero. What we need, you've said it beautifully, is energy additions that are as clean and as technologically viable and efficient as possible in order to reduce the level of contamination. And the level of contamination is not just CO2. Therefore, it makes no sense to substitute nuclear and hydro and natural gas combined cycles entirely by solar and wind, because that is going to entail 60 times more mining of copper. It's going to
hmm
entail massive mining of rare earths, lithium, etc. And obviously, it's going to bring blackout after blackout after blackout because it is a very unstable mix. So, what we need is exactly what you just said. And think about this: it's interesting how China and the United States, the two leading economies in the world, understand it perfectly. I
hmm
went to a renewable energy conference in Shanghai, and they mentioned all the time security of supply, a reduction in coal generation, not elimination of coal generation, reduction in gas generation, but not elimination. What are they thinking of? They're saying, we want to make a cleaner energy mix, but we're not going to compromise growth, security of supply, etc. The same with the United States. The problem is in the European Union. The problem is in the European Union that has this not in my backyard view of what is green energy that is so hypocritical that at the same time has reached record levels of Russian natural gas imports. It's just ludicrous.
I think we can't talk about this enough because I think there was sides drawn early on of who was on the net zero side and who was on the the traditional side of baseload energy, and we're all waking up to the reality that we need both.
And I think that that is what's important. It's not to ideologize energy. The ideologizations of energy is so ludicrous that in Spain, nuclear energy is right wing, and in France, nuclear energy is left wing. What the hell are we?
It's crazy, I know.
It's just so ludicrous that it's funny. And the reason why it's so scary to follow the objectives of these activists is because they're not stupid. None of those activists that are pushing for these completely misguided policies are stupid. The difference is that what they want to implement is demand control.
Mhm.
And because what they want is demand control and degrowth, they don't care if there are blackouts, if there is a problem of supply, if the manufacturing sector doesn't have ample energy, etc. The part of the equation that fits their agenda is demand destruction. Everybody else that wants progress, that wants employment, that wants well being, and wants security of supply needs to understand that we need all available technologies. And at one point, some of them will lead because they're more efficient, better, and they provide cleaner and cheaper power. Fantastic. Why did oil, that's in the energy world is flat, by the way, why did oil substitute whale oil? Crude oil substituted whale oil not because we loved whales or because we had a tremendous sympathy for those beautiful creatures. No, it was because it was easier to produce, easier to store, and significantly cheaper to distribute. So we need to understand that an energy revolution can only come if the outcome is cheaper, more affordable, and more amply supplied energy. The moment that those three elements are not included, then it's not a revolution, then it's an imposition, and that imposition always backfires.
Well, I'm glad you brought up the energy world being flat, because I think that book, which was in 2015, which was even more forward looking than the concept about central banks, touched on a lot of these things, and it's now just kind of starting to take shape. So anyone interested in this needs to go back in time and pull some of these books off the shelf, because you were addressing things before they were even being talked about in public policy, which I thought was fascinating.
I remember that. Yeah, thank you.
Well, let's tie this together. Seems like energy today, you look at what tech companies are doing with nuclear and so forth, with AI and data storage centers and so forth, in markets are becoming more and more intertwined than ever before. How can an investor make sense of this? How can an investor participate in this? Looking at what's happening in the markets, looking at what's going on with money supply, and looking at what's happening in the energy markets. If you're a new investor or an existing investor and want to participate in this, how would you go about doing that?
Okay. I always give the example of a football team. Okay. You need to have defense, you need to have strikers, you need to have a portfolio that lives and breathes with the way in which the economy is moving. So the first thing that you need to do is understand what are the large important trends in the economy, that the ones that are not for the next 6 months, but for the next 10 years.
Mhm.
Technology, energy revolution and change in the energy landscape, and healthcare, aging of the population in some countries, and at the same time the increase in the middle class, fantastic increase in the middle class of developed economies. All those things are long-term trends that you need to invest in. But then you need to have goalkeepers, gold. You need to have defense. You need to have assets that are going to give you some kind of a protection in periods of volatility that allow you to look at those long term trends and see corrections as an opportunity to buy quality cheaply. The way that you also need to prepare yourself is by understanding that the traditional concept of the 60-40 portfolio is gone.
Yes.
That sovereign debt has stopped being a reserve asset, has stopped being the sort of quality, low risk asset that gives you a kicker and a return in periods of volatility and provides you net real returns. Absolutely not. There's no government that is going to give you real returns on your money from sovereign debt because of the challenges of debt and the challenges of spending that we mentioned prior. So you need to shift the portfolio. You need to be probably more exposed to those companies and those equities that are focused on those long-term trends. Instead of looking for safety in bonds, look for safety in gold, in silver, maybe in cryptocurrencies, depending on your risk appetite. But that basically, in my view, gives you the opportunity of escaping from the central bank trap that is only going to accelerate.
Yeah, new actors are entering the stage, so to speak, right? And just for clarification, football terminology was soccer for our U.S. listeners,
Exactly.
correct?
Soccer.
Yeah,
Exactly.
when I heard striker, I was like, I think he's talking about soccer, but I want to make sure.
I'm talking about soccer. Oh my God, I always forget. Yeah.
What else would you like to leave our listeners with that maybe I didn't ask that would be useful for them to hear as we kind of go into this kind of new dynamic of the 60/40 being broke and thinking of different things? What else would you like to leave us with?
Well, I think that for investors, it's very, very important to think of all of the things that are leading the headlines. What do they really mean? What are we really seeing? And what we're really seeing is a monumental shift in the world of money, the way that we have lived it until today. You know, we look at history and we forget that the post Bretton Woods era is a very short period of time in the history of money. And the history of money has always been one of governments dissolving their commitments and dissolving their imbalances through inflation.
Mhm.
So, what investors need to think of is you're not going to find the ways to defend yourself from inflation in sovereign bonds or in those components of the energy spectrum that are fading away in terms of the energy mix. And we mentioned energy prior. Why is oil down but copper is up? It's basically showing you that the trends are moving elsewhere. No? So I think that those are things that I would be focused all the time. It's always about currency debasement. If you want to distill all of the headlines that you read today in any of the economic media, you want to distill everything to one headline, it's currency debasement.
All right, so that's a great way to kind of wrap up the conversation. Now, from an education standpoint, listeners who liked what you had to say today, how can they find you, keep track of what you're doing, see what you're maybe working on today? You know, if you have something that's exciting that you're excited about working on today, how can we track you down?
Okay. I always say that it's easier to find me than to avoid me.
Okay.
It's relatively easy. You look for Daniel Lacalle on Google and you find I have two X accounts, one in Spanish, one in English. I have two YouTube channels, one in Spanish, one in English. So everyone that's watching, you will obviously see quite a few more followers in the Spanish one, but
Hmm.
you have the same content in the English ones. In my website, the same thing. And my books are available at Amazon or any of the online libraries that you might prefer. And what I'm working right now, I just published my latest book, The New World Order, in Spanish, and it will be published in English probably, hopefully, in September.
Awesome. Any spoiler alerts on that book? What are we going to be looking out for?
Okay, spoiler alert. We're going back to 1985. The world
Okay.
is not going to multilateralism, it's going back to very, very differentiated powers.
Awesome. Awesome. Well, Daniel, I really appreciate you taking the time today. I know it's late in the day for you there. I really appreciate you, giving your words of wisdom. And I really enjoyed meeting you today on today's podcast.
Same here. It's been an absolute pleasure. Very good questions. And thanks very much for listening and watching.
Great. Well, thank you all. Once again, my name is Ed Coyne, and thank you for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.